Okay, so in this video, we're going to talk about the third Greek, gamma. And gamma is something that is very important as well. We don't look at it, well, it just depends on the type of trading you're doing. You might look at it all the time. It might be the most important factor depending on your strategy, or one of the most important. But it's very related to delta, as we'll see. And it is a very important metric to keep your eye on. So gamma is the rate of change of delta. So it's measuring delta given a $1 move in the underlying price. So you can think of this as a moving vehicle. It is a great example, and I showed my little red car here. The speed of the car is the delta. You know, if it's a 30 delta, is it a 50 delta? The acceleration would be gamma. So how quickly that might move from a 30 delta to a 50 delta, that's gamma. So we previously talked about how delta will change from day to day as the underlying price changes. You might have a 30 delta call. It might end up being a 40 delta call or a 20 delta call as the underlying price moves for and against you. Well, gamma, it's giving us an idea of what we're in for as the underlying price moves. Again, the acceleration. So let's say in this case we had a in the money long call, and it's got a delta of 70, and the gamma is 0.05. If the underlying went up by $1, the delta would change to 0.75. So it's measuring how much your gamma is going to change when the underlying moves. Now in this case, because we're long a call and the underlying moved up, it can accelerate our gains, right? So we're long that call. So now our 70 delta is worth 75 delta. Wonderful. We're more and more in the money. It's great. It's wonderful. But it can also work against you and accelerate losses depending on which side of the trade you're on. But we knew the effect of a $1 increase in the underlying thanks to gamma. Gamma is telling us what's going to happen and what we can expect. So long options have a positive gamma and short options have a negative gamma. And gamma generally works in favor of long option buyers, especially as the price moves in their favor. That's very, very important. And it generally works against option sellers because as the underlying price moves more and more against them, the losses will accelerate. So again, it's the yin and yang. It's the give me a gotcha. It's the double-edged sword, right? With options, there's always pluses and minuses to every single thing. So because sellers are looking to have time on their side, or they do have time on their side, and realize profit through theta, which we talked about in the last video, that time decay, this is why we'll roll out options as they near expiry. We're trying to avoid as much risk as possible of that high gamma and let theta do its work. Because something interesting about gamma is that it increases towards expiration. And this is where there's a lot of gamma risk, and you might hear that term being used sometimes. So that previous example where we had a 0.05 gamma call option, that gamma might rise to 0.20, for example, in that last week or so prior to expiration, which is great for if you own that option, if you're a buyer. But if you're a seller, that represents a lot of risk that could go against you. And that is that gamma risk. And this is why options are preferably rolled out, a week or sometimes 2 weeks, prior to expiry, depending on the type of trading you're doing. So you can eliminate that gamma risk and take it completely off the table. And like with anything with options, I talk about this all the time. It can work both for you and against you. There's countless different strategies with options, and there are entire traders and entire industries and trading floors devoted to specific strategies that involve gamma and that increasing gamma towards an options expiration date. Now here at Rogue Traders, because we're typically selling premium as one of our primary strategies, more often than not, we're going to have negative gamma. Gamma is usually going to be a little bit of our enemy, to be perfectly honest. Now, that being said, in market uncertainty, sometimes we'll flip to long gamma. We'll buy options in order to get rid of that risk. And we're like, oh, hey, I don't know what's going on here. I want to sleep at night. Now, let me qualify that. We're not going to lead you to unlimited loss setups. So even if you're short gamma, we're going to make sure everything is limited risk for you, especially in this fundamentals video or this fundamentals course. Once you get more advanced, sure, sometimes you might feel okay from time to time taking naked trades, having unlimited risk for short periods of time. But in market uncertainty, we can basically say, you know what? we're going to put on positive gamma. We're going to buy some options. We're going to buy futures. We're going to do whatever we're going to do to give ourselves positive gamma because we don't know what's going to happen. This thing could explode one way or the other. Who knows? If you're feeling that uncertain, we sometimes will do that and we'll eliminate that gamma risk or we'll put gamma on our side. Even if it's just temporary, even if it's just for an overnight position, just to have it there. Okay, fine. That's fine. I know former options floor traders who every night before they left work, they would make sure they were long gamma. So they came in the next morning and bombs went off or the economy exploded or scandals broke out, whatever that's going to affect the market or their individual positions, they didn't have to worry about it because they were long gamma. So gamma is something that we're going to have to get used to. I don't want to say fighting against, but it's one of the metrics that it's usually going to be working against us as option sellers. So we'll eliminate or reduce that risk as much as possible by getting rid of the options prior to expiry. As that gamma starts going up, we'll get out of those options typically. So to sum up here, gamma is the rate of change of delta given a $1 move in the underlying price. It measures acceleration, okay? And it increases towards expiration, and it generally works in favor of buyers and against sellers.
Yeah, so this concept of measuring acceleration is very, very apt in my view. If you're short gamma or short volatility, i.e. you're selling options, then gamma is the how much, if delta is how fast you're approaching the brick wall in your car, gamma is whether your foot's on the gas or not. And how heavily. So it's how quick things are going to get worse for you. So particularly near expiration, as Shane has mentioned, really important to keep a good eye on gamma. And a good way to get rid of gamma that you don't want is either to close the positions or roll them out to a later expiry where things don't accelerate quite so much. But of course, if you're long vol or long gamma, then gamma is a measure of how quickly you're going to get richer. So if you're long options, i.e. you've been buying options, you're looking to maximize your gamma at all points. And there's a whole bunch of strategies around doing that.
All right, so gamma is measuring the rate of change of delta given a dollar move in the underlying. And gamma is a very important risk measure for everybody. For me, it works against me because gamma is generally favorable if you're a buyer of options. It's generally working in your favor. If you're a seller, it goes against you. So it's something that, depending on the type of trading you're doing, you really have to pay a lot of attention to.
Yeah, so for you as a short vol player, delta is like how bad is it going to get overnight, and gamma is how quickly is it going to get worse. So definitely something you need to stay on top of. For me, in the funds I manage professionally, gamma is our friend. We tend to be long gamma funds. So we're paying theta overnight, and in return for that, we're hoping for a big move or a fast change in the markets, and then that helps us win big. And so the exact opposite.